Hello, everybody. It's Thursday, February 27, 2014. It's 2 o'clock Eastern Time. If you're online for the How to Invest in Real Estate with No Money Down seminar, you're in the wrong place. This webinar is yet another installment of the Orion 4L Law Firm Financial Webinar Series, brought to you by those really nice folks at Orion Law Management Systems and their minions here at 4L Law Firm Services. Our topic today is how to decide whether today's bank deposit is sufficient to make budget for the month. One of the great challenges of being a law firm manager, I've learned, is dealing with certain partners who seem to regale in posing impossible to answer questions to us, expecting a yes or no answer. The hardest of these questions are those crystal ball ones where we're expected to know with certainty things that are supposed to take place in the future. Things like, are we on budget as of this very moment? How much cash will there be at the end of the month? Is today's deposit sufficient to make sure we'll meet budget by month end? Today's webinar is about establishing a framework to answer those types of revenue crystal ball questions. A couple of housekeeping matters first. About 2 hours ago, I sent slides to everyone who was registered. If you haven't received them, you might want to check your email or your spam blocker in case you want to take notes on this, on copies of the slides as we go through this thing. At the end of the presentation, you'll be given a link to download a copy of the Excel spreadsheet, which is the financial model we'll be discussing today. It's already formatted for the 12 months of 2014, and there's also a memo that kind of summarizes what we're going to talk about today that also has instructions on how to use that Excel spreadsheet. In addition, my colleague Kim Burney is not with me here today in Studio 4L. She's monitoring the webinar from Dallas and will be compiling questions that you type out over the course of this hour, and we'll probably save the questions for the end. I should introduce myself. I'm Mike Margette with 4L Law Firm Services. At 4L, we perform outsourced bookkeeping, billing, and CFO services for small and mid-sized law firms. We work with Orion software, which we provide to our client firms via the cloud without any upfront fees for software license or data conversion or training costs, things like that. And we work remotely with each law firm as their back office accounting department, supporting the lawyers in the front office. And those front offices are located in 7 states in the District of Columbia. And our typical law firm is between 6 and 30 plus lawyers. The idea behind 4L is that we want to provide big firm financial resources, technology, people, and analytics at a small firm budget. What we try to do is free up managing partners and administrators from much of the day-to-day worry about financial transactions, to provide them with superior financial analytics so they can manage the firms and allow them more time to do everything else that needs to get done every day. So that's the end of our commercial, and now back to our regular programming. I've had the privilege of working in 5 large law firms throughout my career. The financial model we're going to be talking about was developed at that first firm, and I introduced it to CFOs and controllers at the other 4. And each time I try to show this to other people, I would start off by trying to give them a shortcut explanation of the process about how the Excel spreadsheet works, and simply explain, that you put this number here and that number goes there, and the sheet recomputes everything that's needed. And what would happen is that people would listen, nod politely, and go back to their desks, really confused about what this was all about. Acceptance of the financial model, people didn't really embrace it and didn't have that eureka moment until I would take the time to explain to them the circumstances surrounding how the model came to be developed in the first place. So today, since you've already committed to a 1-hour webinar, I'm going to skip the short cut version and tell you a story. It all started a long time ago in a law firm far, far away. But for purposes of this discussion, let's imagine that it's October 2013. Let me set the scene. It's the monthly management committee meeting. The meeting convened right on time at 8 a.m. on Monday, October 7th. The first order of business, as usual, was the monthly financial report, dealing with what happened in the month of September. I held the floor for my usual 15 to 20 minutes and concluded my remarks by reminding everybody that the October fee revenue budget was $500,000, let's say. And I told them that there's more than enough good inventory in accounts receivable to timely collect $500,000 in fees this month. I folded my notes and folded my hands and looked around the table. And then my nemesis, let's call him Partner Steve, took the floor literally. He got up from the conference table, walked over to the whiteboard on the wall, and proceeded to copy some numbers from his yellow legal pad. Here's what he wrote. He wrote 22 banking days in October. He then did 500,000 divided by 22 equals $22,727 per day. He then wrote $69,456 and said, this is what we've collected so far from Tuesday, October 1st through Friday, October 4th. And then he proceeded to do some math. 69,456 divided by 4 days, times 22 days, equals $328,008 for the month. And $500,000, our budget, our target, minus $328,008 equals $117,992 revenue shortfall for the month of October. All this time he was facing the whiteboard, and then he turned around to the room and he looked directly at me, and I'll never forget his words. He said, "What say you to that?" Well, the words that came to mind, I'm prohibited from saying by FCC regulations today. But suffice it to say, I composed myself and I mumbled some words like, I can't dispute your math, Steve. Yes, collections Tuesday through Friday of last week were a bit light, but that's just 4 days. I mean, we've got 18 banking days left this month. And as always, I'm going to continue monitoring collections on a continuous basis, and I'll immediately alert everyone if things don't turn around. Remember, there's a lot of inventory there for us to collect. We've got sufficient fee accounts receivable to hit $500,000, and I don't think it's really necessary for us to start panicking, at right this minute. I don't really remember much about the rest of that meeting. After it was over, I went back to my office and called in the firm's controller, and we started talking. We agreed that Partner Steve's math was correct. Simplistic, perhaps, but you can't really refute math. But the question was, what better math could we produce that would refute his writings on that whiteboard, or what math could we produce to say maybe he's right? We talked about what kind of reports we could generate from our computer system, okay, to tell us, whether we should be panicking now or not panicking, and so forth. For those of you who watch NCIS, I probably made some comment about my Leroy Jethro Gibbs gut, and my gut was telling me that I think we're going to make budget this month. But then again, the firm wasn't expecting me to manage their finances based on gut instincts alone. They were expecting me to apply financial analytics, in managing the firm. The controller pointed out bluntly that while we budget revenue on a monthly basis for obvious reasons, he said, isn't it nuts that we go an extra step and actually budget revenue on a daily basis as well? I mean, is that what they're asking us to do? Is that what we need to do? Neither of us really knew the answer to that question. Eventually, the controller and I ran out of things to say about Partner Steve's financial expertise, and we returned to our regular use. Now, it's significant that all of this happened in the month of October. And by the way, this was in Chicago too. And it's because October in Chicago is many things. It's also the time of the Chicago Marathon. And that next weekend, a local television station was broadcasting the race. My wife, who's run several marathons, was watching that on television that afternoon. And I was enjoying a rare Saturday at home. But what caught my attention was that the lead runner, the announcer said, was on pace to break the Chicago Marathon record time and possibly even the world record. And every once in a while, the station would throw up a graphic that looked something like this, which would track the lead runner's progress over the course of the race. By the way, the meters at the bottom, they're 42,000 and change meters in a marathon. Now, this isn't that particular Chicago Marathon race. This is a summary of the time splits recorded by Wilson Kipsang of Ethiopia when he set the current world record for marathon running in Berlin in 2013. What this graph shows us is that it took Kipsang 17.57 minutes to run the first 5 kilometers. He ran the second 5 kilometers in 14.7 minutes, and so forth. So you get the whole picture of what this was. So the first thing I concluded by watching this type of graphic come up on the TV screen was that very clearly a world record pace and time can be set without running every mile at the same speed. It occurred to me that maybe different runners would be able to cross the finish line at the same time he did and run the race differently. For instance, here we have a runner in blue who is starting out faster than Kipsang, and runs faster than him for the first half of the race, and then runs slower than him, for the second half of the race. And then similarly, there could be another runner who could match the world record pace by conserving energy, here in red, running slower than Kipsang over the first half of the race, and conserving energy and making up the distance behind over the second half. Different runners could have the same total time, but run each 5K at a different pace. And that's when inspiration struck. It occurred to me that a question occurred to me. It was, could we build a theoretical financial model based on this sort of data and somehow apply it to calculating the pace that we need to collect our daily revenues in order to hit budget each and every month? Specifically, I started thinking about how can we substitute like the term world record time for monthly fee revenue target. Can we substitute the distance markers, the 5K markers for each banking day that we have to do? Could we substitute the split time for the amount perhaps of the daily fee deposit? And of course the cumulative time that the runner has run so far against our month-to-date fee total. Could we try to build an analogy like this and then build a financial model that we could use to track whether or not we were on world record time in terms of collecting our monthly budget. The challenges, of course, in putting together a model like this, which is, I guess, like different marathons too, is that not every race is the same. Each course is different. Obviously, Boston has Heartbreak Hill, at the end. Other courses have, hills and valleys at different points during the race, and also, things are different because weather conditions and other things, differ from course to course. But two deep questions finally became focused as the controller and I and others in the accounting department tried to kind of talk this thing through in theory. And the first was, is there a daily pattern to the collections that we have, each month? And secondly, if so, can we somehow use that pattern of collections to apply it against the progress that we're making toward making our revenue collection target in a given month? So, remembering our high school science classes and so forth, we decided to adopt the scientific model and put together what we called our first hypothesis. And our first hypothesis was that over the course of an average week, our firm collects X% of the eventual total weekly revenue on an average Monday. It collects Y% of what's going to be totally collected for the week, on an average Tuesday and Wednesday and Thursday, and so forth. So again, staying true to the financial model, we started collecting data, and to test our theory, we collected a lot of data. Specifically, we looked at a 22-week period covering Monday, April 1st through Friday, August 30th. We ran a bunch of reports from our accounting system, and we copied that data, into an Excel spreadsheet. This whole process took about 2 hours for us to populate the Excel spreadsheet. There's nothing magical about 22 weeks, but we thought that that was a big enough period of time that if we put the numbers down, a pattern might become apparent. The more data we put in, the more apparent the data came to us. We also noticed that some of our data wasn't necessarily good data. Again, remembering our theory was that we wanted an average week. So during the course of this 22-week period, there were a couple days that were anomalies. One day there was a $448,000 contingency fee receipt that came in. All right. And on another day, there was a $250,000 lump sum settlement that we had with a long-term client that owed us a lot of unpaid invoices for a long period of time. We decided that those weren't typical receipts received in a typical week, so we took those numbers out of our data and just recorded instead, for the purpose of building this model, what would a normal receipts and deposit have been, without them. Then another anomaly that we found with our data was that we had to deal with banking holidays. For instance, the firm was closed on Monday, May 27th, all right, and it was also closed on Thursday, July 4th. So what we decided to do with this anomalous data was that since we were looking for the average Monday, we decided just to split the difference. So the $33,000 that came in on Tuesday, May 28th, we just decided, for the purposes of our analysis, this is not, an absolute science, that we just would say that if it hadn't been a bank holiday, we'd have collected half the money on Monday and half the money on Tuesday. And the same thing with the 4th and the 5th of July. We took that $18,000 and change and decided to split it between the 2 days. With the Excel spreadsheet filled out in this way, we found out that on an average Monday over this period of time, the average Monday take, if you will, was $29,519. The average Tuesday was $17,476. Stated another way, we found out that on an average week, the total amount of money that we're going to collect that week is likely to come into the firm and be deposited on Monday of that week. 22% on Tuesday, 16.3% on Wednesday, 14.2% on each Thursday, and 10.4% on each Friday. From this data, we made two conclusions. The first conclusion, I think is pretty obvious. I mean, again, from the way we approach this, on an average week, this firm will collect 37% of the total amount to be collected for the entire week on Monday, 22% on Tuesday, and so forth. The second thing that we concluded from this preliminary work is embodied here in conclusion number 2, and that is that all other things being equal, if your firm collects a disproportionately large percentage of its average weekly collection total on Mondays, for instance, 37.1%, then the firm will collect higher revenues in months with 5 Mondays than it will collect in those months that only have 4 Mondays. Right? And we built this little model, to show this, and to prove that second conclusion. Here we have the months of April 2013 and August 2013. Both months have 22 banking days. Neither month has got a bank holiday or other holiday, in it and so forth. And again, all things being equal, if the firm collects $100,000, per week, in the month of April, the firm is going to collect $459,100. Whereas in the month of August, the firm's going to collect $424,600. And the only difference is April has got more Mondays and more Tuesdays, whereas August has 4 Mondays and Tuesdays. Now, those of us who work in law firms know that theory is a nice thing, but theory will only take us so far. So the question, of course, came the next big challenge, which was, okay, how can we take this theoretical information that we have and somehow put it to practical use? So this caused us to come up with what we called our second hypothesis. And essentially was that we could take the second hypothesis was that there is a way, okay, to find out how to take the data that we got, which supported conclusions 1 and 2, and apply that to looking at how we the pace that we're on to collect money for the month, much like tracking the pace of a runner trying to match Wilson Kapsing's world marathon record. So over the next several slides, I'm going to take you through how we built the financial model to find a practical application for this data. The first step in that model was to to figure out how we're going to track the pace that we need to hit the high points and low points of the course over the distance of the month that we're running our collection race. So in column A, we simply listed the 31 days of the month. In column B, we put the day of the week that's associated with each of those days. And in column C, we put in that percentage factor, okay, that that says that this is how much money we would collect on an average week, okay, on that day. And at the bottom of column C, you'll see that all of those numbers totaled up to 452.8. And then we did some math, in column D, and that's the math is shown here over on the right hand side of this slide. If your factor for Mondays is 37.1 out of a total of 452.8, all right, then that percentage times 500,000 means that every Monday, if you want to stay exactly on Wilson Kipsang's pace, on Mondays you have to collect $40,967 in fees. And here's the math for that. Every Tuesday, to stay right on that pace, you have to collect $17,999. On Wednesdays, this amount. On Tuesdays is $24,293. Wednesdays is $17,999, and Thursdays are $15,680, and Fridays $11,484. All right. You total all those numbers up, and you're going to tie the world record by meeting the $500,000 collection goal for the month. Now let's apply this to the real world. Okay, in the real world, we're not going to run right alongside Wilson Kipsang, every 5 kilometers along the race. Some will run faster, some are going to run slower. What happened on Tuesday, October 1st? On Tuesday, October 1st, we collected $22,293, less than what we wanted to collect that day. We wanted to collect $24,293. So we're running behind Wilson Kipsang. Now, do we expect to make up that whole distance over the second 5 kilometers over the next day? The thing is, no. We need to close the distance, but we have another 21 banking days, okay, to make that close. So what happens in the financial model is that in column E, we put in the amount that we collected that day. In column F, which is a repeat of column C, because Tuesday has already come and went, okay, we don't have we don't have that same collection factor available anymore. And in column G, we recompute how we're going to make up that pace over the course, make up our shortfall from Tuesday over the course of the race. So what the schedule is telling us is that instead of hoping to collect $17,999 on the next day in order to get back on the pace, we will be back on pace if we're able to pick up our speed just a little bit and instead collect 18,075. And the math here, again, is recomputed, for you, at the bottom of the screen. Again, the theory here is, okay, we've fallen behind by $2,000, but instead of hoping to make up the whole difference on Wednesday, the whole $2,000, all we have to do is, we'll be okay if we pick it up just a little bit over the course, pick up that $2,000 over the course of the remaining 21 days. Again, with reliance on what our normal collection pattern, is going to be. What happened on Wednesday? Well, to illustrate how the model works, we did pick up that $2,000 on Wednesday. On Wednesday, we collected $19,999. Okay, more than we originally had hoped to achieve, and more than the $18,075 that we had computed the day before. As a result, okay, of doing this, again, you see that we've collected these two amounts on Tuesday and Wednesday, the total for the month to date. These collection factors are done, and we have 414.5 mile markers, yet to pass, at various speeds throughout the course of the race. Because we're now back on pace, okay, oddly enough, and not oddly enough, this is the way the math works. We're looking now at the end of the day on Wednesday, hoping on Thursday, let's stay on pace. Okay, we've caught up to Wilson Kipsang. We need 15,680. Okay, on Thursday. Now, of course, it never works out that way. On Thursday, we collected 18,000. $680. All right, and here again is how it's represented in the financial model. What does that mean? It means that going into Friday the 4th, all right, originally we needed to collect $11,484, to stay on pace. Now, okay, we can conserve energy a little bit. Okay, again, just to get to the 500, we can slow down a little bit and remain on pace if we collect 11,406. On Friday the 4th. The next day, however, we don't. Okay, we have a disappointing day, and we come in with only $8,484 is our collections, for the day. Okay, again, you do the math. You've got these many factors to go, and then again in column G, you recompute the pace that we have to do. Okay, and you see that yes, Friday the 4th was a disappointing day. We've already known that. Partner Steve has told us about that already. All right, but it happens to be that on Monday, we're right back to where we need to be at 40,967, the original amount, and also the recomputed amount, to stay on pace. We're running faster, we're running slower, but if we can maintain the pace that we're on, and so forth, we will get exactly where we need to be. We're going to collect the additional 430,544, just like we were going to, at the beginning of the month. This isn't a theoretical, thing. This spreadsheet I've used over the years at these firms, and we've used it on a couple occasions with client firms that we have at 4L. Most notably, I use this. I started using it just in the months of November and December when we were engaged in our year-end collection push, and it helped a lot when I had to talk to the partners about how do you think we're doing. At Jenner and Block, for instance, I had 5 partners scattered over 3 offices. There happened to be 5 people, and there were 3 different offices who used to like to talk to me and used to like to call me at different times during the day, to say, how are we doing? What do you think? Are we going to make budget, for the month, and so forth. What I used to do was simply have the person in the accounting department who made the bank deposit, pull up this spreadsheet, put the information, that's needed in there, and then send me an email. All right, and I would print out this schedule. I carry it around in my pocket in case I wanted and somebody asked me a question in the hallway. I have so many numbers jumping around in my head, it's oftentimes difficult to remember exactly what was today's deposit, and things like that. But I would have this schedule at hand, whether in the hallway or when I take a phone call, and I'd be able to use it as a set of talking points, with the partners, to be able to talk about how we did, yesterday and how we did last week, and what did I think the collection pattern, was going to be for the year. Were we running faster or slower than Wilson Kepsing, in our attempt to tie or better the world record, which was whatever the budget amount was, for the month. Maintaining this schedule takes practically no time. As I said, an accounting clerk did it. It took us about 2 hours to fill out the one worksheet to kind of figure out what our daily collection pattern, is on each, day of the week. But what it gave us was a foundation for having an intelligent discussion with the partners and showing them how numbers work and how collections differ from day to day. Does it predict the future? Of course it doesn't predict the future, but it gives you a framework to have an intelligent discussion. If only I had had this financial model available on that fabled Monday, October 7th. I might have been able to come up with a much better response to partner Steve and his famous question about what say you to that. I would have been able to tell him, I think, that meeting the monthly revenue budget is a marathon. It's not a 4-day sprint. That I'd be able to tell him that the firm collects a disproportionate amount of its weekly revenues on Mondays. And his $69,000 total, which he was making such a case about, didn't include any Mondays. I'd be able to reiterate the fact that we had more than enough inventory on hand. And based on the best data available as of this moment, all right, I have some mathematical numbers. I have some math that's different from yours to look at. And this is why I don't project a $117,992 shortfall for the month. In fact, on the numbers that I just gave you, I believe that we're exactly on the world record pace to meet the $500,000 revenue goal, okay, for our month. Now, I'm going to give Kim a couple seconds to, kind of summarize the questions that we might have today, but I'm going to anticipate a couple of the questions that you might have when you work through the data. And that is about how you deal with bank holidays, all right? And they crop up, I think 7 times. I might be wrong about that number, during the year. What we have always done with bank holidays is we've just decided to make the difference. I mean, we don't want to, if there's a bank holiday on October 14th for Columbus Day, we took the 37.1, okay, that's the number that's assigned to a typical Monday, and added that to the 22% factor on a Tuesday, all right, in order to do the math, in the financial model, and that works pretty well for us. It sometimes doesn't work that's the general rule. I fudge sometimes for the day after Thanksgiving. The day after Thanksgiving typically is a slower collection day than a Thursday and a Friday together. The same thing with the whatever the banking day after Christmas. It typically is. Again, it's whatever you think works right in your firm to kind of reflect what the collection pattern might be. Another question, and that we've had to adjust for from time to time, is how do you adjust the model to deal with a one-time item that is going to happen that isn't reflective. It's an anomaly in itself, but it's going to be a collection anomaly. It's going to be a real thing. And I illustrate this in chart 4.1. The assumption here is that we know we're going in the month. Our budget for the month of October is to collect $500,000, but we know a client has promised us that we will receive a check, no matter what, no questions asked, absolutely positively. It's not in the mail. It's going to be hand delivered to you on Thursday, for deposit on Thursday, October 31st. And in that case, we just kind of fudge with the math, okay, to make it work. A typical Thursday has a $12,544 deposit, and in the you can do the math like the formulas that I've shown you before. You can also just do it by trial and error. But in this case, under this set of circumstances, I would adjust the collection factors for this date, increasing it from 10.4 to 127.4 to reflect the fact that we expect to have a normal collection of $12,544 on this Thursday, plus the extra $100,000 from the client. And again, so when partner Steve says that look at how bad collections are all these other times during the month, and and does his math by dividing by the numbers of days, and then multiplying by 22, we can say, wait a minute, okay, your math isn't taking into account, okay, the fact that we expect to collect an extra $100,000 on this particular day. And and in fact, if for some reason the firm doesn't make budget for that month, the reason, again, the explanation of things is you didn't make budget for the month because you didn't get this $100,000 check in. You did get the other $400,000 that you expected in the normal course, and so forth. And it wasn't an overall collection failure, but just a failure with respect to this one particular item. There are other firms that we deal with who have a certain amount of money that comes in on the 15th of every month and so forth. And again, the model is designed to take care of those kinds of things. In the where am I here? In the in the slides, and I'll put the slide up again, there's a link that you can go to. This memo is a summary of the story I've told you and the numbers that I've taken you through. And there's also the instructions on how to use the Excel spreadsheet that you have. The Excel spreadsheet is already set up for the months of 2014. I have a chart here which shows all 22 weeks that we came up with in order to find our collection patterns together with the bank holidays here and so forth. Here is the month of October 2013 in case you want to replicate the numbers that are in the charts 2.1 to 2.5 that we've gone through. And also, again, the instructions are very clear that you put in your budget for the month. Let's say $750,000. These numbers compute automatically, and then as the money comes in each day, it tells you whether you're over or under, and then recomputes the new target for the next day. And so forth. My gift to you: enjoy. If you improve it, let me know, and I'll pass on that information to others, in the future. I've like I said, this has served me well, and I've enjoyed working with it, and it's been a big boon to me over the last few years. So we've got about 45 minutes into this, and I guess I'm going to ask my friend Kim to let me know if she's got any questions that anybody wanted to ask.
Well, hello there, Mike. Can you hear me?
Can hear you fine.
Okay, good. Yes, we did have some questions, and I'll start at the top, and we'll go from there. Let's see. Robert Miller said, "How did you select the $500,000 for the month? And also, how do you factor in that clients may pay on the 1st and the 15th, no matter what day of the week it is, or does it just average out?"
Two good questions. The 500,000 is the budget. Okay, it's the budget number that was we're trying to hit budget for the month, and and of course that's computed in a whole another session, and maybe I'll plan a webinar sometime on revenue forecast, revenue budgeting and whatnot. First and the 15th, if there are two ways of dealing with that. One is to put down your 22 weeks or whatever you think is a representative thing to look at the pattern, and maybe it will just all average out. The other would be to, I think that what I might do is if you're really driven by that kind of, 1st and 15th or really anomalous, days, I might take the 1st and the 15th, I still put down the 22-week, information, and then factor for it. And if Robert wants to come up with some raw data, I'd be happy to again, pro bono, work with him to massage it, to have a better answer for that kind of thing. But I think you can massage for it. And the other thing, I guess too, let me skip over here. One of the things with the model, is that the first. Well, let's go back. Let's go someplace with the first business day of the month, I guess, is the first. You can increase that. You can anything in blue here. You can override. Okay, so you can go in and override that. Make the first and the in the 15th larger. Take on a larger percentage. Which then increases the total down here, which then recomputes all the numbers. That's my answer.
Okay, good. Let's see.
The best I can.
That's a good one. I have other questions, but Carol Miller has tried the password soda, and she said it doesn't work for the Excel worksheet.
Yeah. Well, you'd only use that if you wanted to go in and change, if you wanted to change this formula, this if statement there, okay, and change, change those, those type, I'm surprised that this question came up right now, okay, because it would only, that only should come up if you want to change the protected cells in here. But how do you do that? You go to, if you want to, but if you want to do that type of thing, you go to, is it data? Formulas? It's on page, review, oops. Yeah, you go to review here, and you hit this, and it has, then there's where you put the password in. Yeah, so and then soda will unprotect the so you can go in and adjust those worksheets, those protected columns. So, and
okay.
Give me a call, but I only predicted them so that they didn't get corrupted inadvertently by somebody.
Good plan. Okay, Marvin is asking, he said, we issue our invoices to clients on the 10th of each month via email. I noticed that we have greatest collections during the 3rd week of the month, and the 1st week is very low collections. Does it make sense that perhaps it should be looked at a monthly flow rather than weekly flow, and treat Monday like a day after a bank holiday?
The answer to his question is yes. Okay. I think each firm is going to have its, a pattern, a particular pattern, may develop, and the firms that I've worked with, we've seen it. It's usually been a day of the week, type of thing. Again, these, these numbers here can be, are subject to overriding, for bank holidays and, those big checks and so forth. And Marvin, I know who you are. And if you want to work on that again, I'll be happy to look at your firm's pattern and help you devise a manner to make this model more applicable to what your situation is. Yeah, without data that shows that, it just never occurred to me. So anyway. So be happy to do it.
Okay, and Tracy had a question. In addition to the varying by days in the week, our collections also vary by month. For example, December is always our greatest collection month. Would you then suggest we provide a monthly percentage to the daily collection calculations?
Um, I think that the model takes care of that for you because I mean the number that you want to put in, for the month, is what your budget for the month is. Okay, so yeah, I probably shouldn't have given this to you with 500 across, but it's each month's budget. Okay, so the month of December would be bigger. Okay, so your budget for December is larger too. So, I mean, the budget number that you put in for the month of January, maybe a 500,000. February, whatever your collection budget. February is usually January usually is a slow collection month because the clients are tired of signing checks in December, okay, to help us make our budget for the year. So January, February, March are usually slow collection, months. The firms that I've worked with, April, things start building up again in April. August is usually a bad collection month because everybody's on vacation. Clients, checks don't get, invoices end up on general counsel's desks and don't make it to the accounting department. Things get to the accounting department and there's not a vice president to sign the check. Things like that. So, so figure out what so every month's budget is going to be a different amount, and then I think so. All other things being equal, your budget for December is going to be $1.2 million. Your budget for November might be $1 million. Your budget for October might be 800,000. And the model takes care of it by just putting a different amount into the blue box on line 2 here.
Okay, cool. And Kathy has a question. She said, do you believe the daily percentages you came up with are the norm in the industry, or are all law firms unique?
All law firms are unique. Um, uh, I recognize I didn't say that part of the thing that got started on this is that every law firm is unique, as Marvin indicated. That's the case. I think there's some insurance defense firms who they have a practice. If you can get your invoices sent electronically to the insurance company by the 5th of the month, you get paid on the 15th. So they get a disproportionate amount of their money, on that particular day. So the 37 on Mondays, other firms it's going to be 40 or 35. It's of corporate firms, but firms with general corporate practices, I think, generally have more receive more money on Mondays and Tuesdays than they do in the latter half of the week, and that is that those firms, their clients, have a tendency to write expense checks on Thursdays and Fridays, so they have the weekend float, on the while the check is in the mail. So, again, every firm is different, but if you've got a general corporate practice, Mondays and Tuesdays are going to be disproportionately higher.
Okay.
We're losing our audience.
Yes, that you typically have. That's okay, because we're down to the last question that we have. So this is perfect.
Okay.
Enrique asked, do collections include fees and cost, or just fees?
I could have been more clear, and I am more clear in the memo that you have. That I always it is my practice to focus on fee revenue. Okay, if you're worried about your cash flow, you worry about fees and costs. But I generally worry about making the revenue budget for partner compensation purposes, and my bias is to just track fees. So you can do it either way, but when I've been talking, it's just been fees.
Okay, perfect. And I think that's a perfect end to this call, because we just answered all the questions that were out there. Whoop, wait, yes. Oh, somebody just said thank you. Of course, thank you.
Okay. Well, listen, guys, thanks so much. I'm overwhelmed that you all showed up, and we appreciate it. And I hope it's helpful. And I'm here to talk about this or anything else. I'm not a consultant. I like solving problems, and if I can be of any help to anybody using this thing or any other thing, don't hesitate to give me a call. My contact information is on slide 2. Thanks much. Bye.
Thank you. Bye.